Hello, class, and welcome to this chapter 1 handout 2 answer video. So let me share the screen. You should have this handout attached with this video if you're watching through my Canvas page, right? So what we're going to do is we're going to go through this handout here. We're going to prepare a cost of goods manufacturer statement. We're going to compute the average cost of producing 1 unit of product throughout the year. And then we are going to prepare an income statement. And this finishes up what we are learning in chapter 2. However, before we do that income statement, right, we need to find our cost of goods sold. The first thing I like to do when working a problem like this is we want to identify what we have here. All right, so let's look at our handout here. And everything we have here, we're going to use to calculate our direct materials. All right, as further we go on to identify things here, we have direct labor. These four costs are all manufacturing overhead, indirect labor, rent, factory building, depreciation, factory equipment, utilities on the factory. So I told you, anytime you see the word factory, almost identified as a product cost, all indirect product cost becomes part of manufacturing overhead. Over here on the right side, all these, those are selling and administrative costs. Okay, we'll get to them when we do the income statement. And then our final 4 things listed over there, those are just some beginning work in process, ending work in process, and beginning finished and ending finished goods inventory. That's all information we are going to need in order to do this problem. So the first thing we want to do is make a cost of goods manufactured statement. This is what it would look like. We always start with our beginning work in process number. Right, we got that straight from the handout. It was 13,400, talking right here. To that, the next thing we need to do, now we need to start adding in all of our product costs. Okay, our 3 product costs again are direct materials, direct labor, and manufacturing overhead. On our handout sheet, you'll notice that the direct materials wasn't exactly given to us. We were given some inventory numbers and some purchases numbers. We only want to add in the cost for what we used in production. So it wasn't specifically told what we use. So we need to calculate that. We start by that. So what we're doing right here in these lines right there, we start with our raw materials beginning inventory of 46,800. We add to that our purchases of 320,000. This tells us how much materials we had available to use in the period. From that, we subtract out our ending raw materials of 66,800, and that tells us that we used $300,000 of materials throughout the year. So that is our direct materials used. To that, we add our direct labor, which was given on our sheet at 200,000, and then we add in our final product cost, which is manufacturing overhead, totals 153,000, and again, that is adding up that indirect labor, the rent, the depreciation, and the utilities that we marked on our handout as being product costs. So now we add all 4 of these together, right? Do not forget when we add that we got to come up here and get this top one included in there. That's the most common mistake made by students. Excuse me, they like to add the materials, the labor, and the overhead, but they forget that beginning work in process, that beginning WIP. So we add all those together. That is our total production cost of $666,940. So for the year, that's how much cost went into production. But we only want to know what the cost of the products that were finished, right? So to get our cost of goods manufactured, our last step from that total production cost is to subtract out the ending work in process inventory, which is given to us in our original handout of 14,940, gives us a cost of good manufactured of $652,000. So that is the amount of everything that we finished during the period. When we get into our next chapters and we start talking about journal entries, the cost of goods manufactured is going to be the amount that is transferred from the work in process inventory into our finished goods inventory. Okay, final thing we want to do on this sheet, it asked us how much did it cost us to make 1 unit throughout the year. So we take our cost of good manufactured, again, which is the total cost of everything produced. We divide it by the 4,000 units it told us in the problem that we produced this past year, and it totals out to $163 per unit. Right. So as we move on to the next step, it wants us to make an income statement. Before we can make an income statement, though, we need to find our cost of goods sold. So that's what I have here on this sheet. To find our cost of goods sold, we always start off with our cost of goods manufactured. Right? We just calculated that on the previous page of $652,000. To that, we add our beginning finished goods inventory, which our handout gave us as $80,000. When you add those two together, those become your COGA, COGA. That stands for cost of goods available, right? So if we sold everything, it would have cost us $732,000 if we sold everything that we have sitting in our inventory. However, we didn't sell everything. We took account of our ending inventory. And we got 114,100. So we need to subtract that out of our cost of goods available to get our cost of goods sold, which is $617,900. Now that we have our cost of goods sold, we can make an income statement. Hopefully you all remember how to make an income statement, a general one from Accounting 1. But here's how we do it. Our top line is always sales or sales revenue. In order to get our sales, it's the units we sold multiplied by the selling price. Our selling price was given to us at $400. How do we find our units sold? Well, we need to look at the other information they give us. And that's what I did over here. I did that calculation. We had 500 units in our beginning inventory. We produced 4,000 during the year, and we had 700 left over in our ending finished goods inventory. And those are units, not dollar amounts. So we sold 3,800 units. We take that multiplied by the selling price, we get our sales of $1,520,000. We subtract our cost of goods sold from that, which we just calculated on the previous page of $617,900, gets us a gross profit or a gross margin of $902,100. Again, that is a great number to remember, right? Gross profit, gross margin. If you had me in Accounting 1, I told you that whenever you're in the real world, that is the number that they're going to base your performance bonuses off of. Because cost of goods sold, right? Our labor, our materials. As a manager, that is what you can control, right? You can control waste, you can control inefficiency. You can't control a lot of the selling and administrative expenses. So gross profit is a lot of times what they're going to base your bonuses off of. It's a great number to know and know how we get it, right? Sales minus cost of goods sold always gives us gross profit. From there, we need to take out our selling expenses and our admin expenses. I just totaled them up here. I didn't list them separately. So our selling expenses would have been the sales supervisor's salary and the commissions added together to get $207,000. The general admin expenses were given to us as $300,000. When we subtract those out from our gross profit, we get a net income of $332,100. Ladies and gentlemen, that is how you get from a cost of goods manufactured statement to a cost of goods sold statement, and finally to an income statement.